paradigm shift. A paradigm is a standard way of looking at things, usually based on a coherent set of ideas. A paradigm obviously inspires specific actions, call them policies. The paradigm that inflation must be contained and public budgets must be balanced has had a long life. It has inspired fiscal and monetary policies for the last 40 years. It is now a dying paradigm. In other words, we are in the midst of a paradigm shift, a fundamental change in the way we look at the same things. In all advanced economies, policymakers and experts are questioning the need to contain inflation right now and at all costs. They are also challenging the view that public deficits must be contained. Paradigm shifts, of course, occur in the course of history. In 1933, President Roosevelt engaged in the so-called New Deal, massive government-financed infrastructure spending. He also abandoned the gold standard, allowing the dollar to depreciate against gold and most other major currencies. After World War II, the US again adopted a pact with gold, but in 1971 it abandoned it once more under President Nixon. When back in the early 80s China opened up its economy, she pursued a prudent fiscal and monetary policy and kept it like that for almost 3 decades, only to completely abandon it after the 2008 global financial crisis. Indeed, since then, she has engaged in massive credit stimulus through the banking system, leading to a tripling of the country's total debt as a share of GDP in less than a decade. Today, the US is bent on a new historical paradigm shift. The new Secretary of the Treasury, Mrs. Janet Yellen, has confirmed that the country has to act big. The US fiscal deficit over the 2020-2021 period is likely to reach almost 30% of GDP. In 2020, broad money shot up by a staggering 20% annual rate, and the Federal Reserve has decided it will not raise rates if inflation shoots up by more than 2%. Other developed economies are likely to follow suit in breaking down the old paradigm, albeit not with the same intensity as the United States. For investors, it's important to note that the US in 2021 is not like China in 2008, nor is it like the US in 1933 or even 1971. Today, US capital markets are 50% of global capital markets, and the US dollar is by far the dominant reserve and trading currency. If, as seems likely, the new paradigm shift pushes the US economy from the disinflationary environment of the last 40 years to a new inflationary regime, it will have implications for global assets. Of course, in the midst of the pandemic, people will not necessarily immediately increase spending of the new money the government is showering them with. Inflation might still take some time to come. Likewise, whilst the dollar should weaken over a longer horizon and thus provide liquidity in emerging markets, geopolitical tensions might temporarily reverse that trend. But what matters is that gradually we should see a reduction of the returns on all global financial assets, as the present value of future cash flows will be eroded by higher nominal discount rates. Also, whilst all assets will do less good, low duration assets will suffer less than high duration assets. And together with a weaker US dollar, US stocks should suffer more than emerging and European stocks. In sum, the 20s look less promising than the decade we are leaving behind us, and more difficult to navigate too.